GetCrack. Wake up, motherfucker.
Yo, what's up, guys? It is the Ides of March, March 15th, 2025. All right, so we got some busy week ahead. We got Max Payne. We have some NVIDIA conference. We have Jerome Powell. We have Bank of Japan Uedo. Lots of stuff coming through, all right? So we got to be prepared. Let's look at the charts right now. See how we ended Friday. We look like we ended pretty well. So, as I've said, I'm not interested in doing any day trading per se. I'm really interested in a bounce. I want to see a big bounce. This is the bounce I'm waiting for. Once we get that bounce, maybe it'll last more than a week if you're lucky. You can a week and a half perhaps. But if not, be prepared. Be prepared to go the other direction again. We're going back down. And at that point, yeah, I would probably start recommending everyone just short everything to hell because that's where we're going to go. A lot lower into tax day. All right, tax day. That's probably where the worst point will be. But for now, let's look at the bounce. So if we look at this chart here, SPY, we finally closed right here above this hourly moving average, all right? 18 hourly moving average. And you see the MACD is moving up. Very good. So you see the lower low here, higher high here in the MACD. It got a follow through. We're getting closer to the zero line on the MACD. And then you see the ADX going down, finally dropping below this gray area. This gray region is the transition between the strong trend going into a sideways. So this doesn't guarantee that it's going up, but at least we could probably fight in this region for a lot longer and see if we can make it by the time Jerome Powell opens his mouth, right? That's one thing I'm waiting for. Let's look at the QQQ is the same thing. Yep, same thing. They're pretty similar. So let's look at what we have here. MSTR, excellent, up 13% on Friday. So if you bought on the Monday here at 235, we're up at 297 now in through this gap region here set back in November. Okay, next target, if we can make it, is 322. That'll be the next point you want to sell some chunk. So you can sell along the way up, right? Here through here on Friday, and you'll sell your next chunk there. If you're an MSTX, let's see, we're at MSTX. That's the 2x leverage, around $28.71. All right, $28.71. See if we can get to the 35 area for MSTX. That's 2x leverage. Now, SMCI, let's see how that one's doing. I think we had a pullback. Yeah, we had a pullback here on Thursday. We're bouncing back up. So we're still kind of unsure if we can break this 42 area. Okay, 42 area here. SMCX, let's see. So this 2x leverage. All right, let's see. So let me see how far we got to go here. So if you're in this one, see how high you possibly can go. If it can fight its way back up to 48. So 16% about SMCX. So if you're an SMCX, 16%. Let's see, 32 equivalent. So 68 on SMCX. Okay, 32%. All right, interesting. Now let's see what Tesla's doing. That's the other one to pay attention to. Tesla right here. Okay. It was up 3.86% on Friday. Still needs to do a lot more work to get to 283 back up here. 13% for Tesla. So TSLR, if you're in TSLR, see 26%. So 18. So that's where you're going to look for the target, 18, around 18. And then the other one, NVIDIA. So NVIDIA will have a lot of news coming out. They're going to have a conference. Let's see. I think it starts on Monday. All right. See what happens there. They're going to talk about AI. Let's see how that pumps up. But Powell will be the more important thing. See if it get to 129. It's been doing good so far. So if you bought it on Monday, you're up 15, 16%. Very nice. So NVDL. So you got a little bit more to go. A little bit more. Maybe 10% more. Maybe you can get to 52. If you're lucky, you'll get to 55 or something here. 15%. Maybe. Let's see. 55. Can it do that? Yeah, maybe. Maybe you can get to 55 for NVDL. So that's a 2x, 2x, I think. 2x leverage. Yeah, 2x leverage. Perfect. So those were the stocks I recommended. MSTR, right? NVIDIA, NVDA. Then you got SMCI and Tesla, TSLA. And then you have your leverage versions of those. So those are scrolling on your screen. So you can go there. What other ones did I say? Oh, SOXL, SOXL. Okay, it was up 9.45%. I don't know how much it will recover with NVIDIA. Intel had a lot of nice news to offset everything too. So there's a lot of hype coming through. The news cycle definitely wants to keep it volatile. I have no clue how much more noise we can get over the week, but for certain, you're going to have max pain. All right. WebL is the other one. WebL. Okay. So like I said, I was kind of skeptical about how much WebL I want to do. It definitely got a nice low on Thursday. It popped on Friday. We'll see. I don't know if I'll pick some up or not. If I haven't decided yet on Monday, we'll see. And this is like the 3x leverage of FDN. So SOXL is the 3x leverage of SOXX. Okay, so these are leverage ETFs if you want to play for the bounce on the Nasdaq. So these two areas. So if you think the Nasdaq's coming up here to 500, yeah, you can play those two. I don't know which of those sectors will outperform the other. You can play both, since we don't know which of them will do the best. Might as well do both and see what happens. Okay, anything else? ASTS, yeah, still stuck here. I don't know. I don't have much hope for it anymore, really. Like, I don't think it'll make it in time. Unless, like, Powell says something crazy. This could have a temporary bounce. Like, it could just suck people in after it breaks, like, 35 to 38. Maybe it'll be a good small cap trade, but I don't trust these small caps. Nothing here will last very long. Like, you look at Sound, right? It's bouncing off of this area. Yeah, okay. Maybe you get lucky and it'll get to up to 18 for like a day. Maybe even like an hour or a minute. And then it'll just drop all the way back down. That's probably it. That's probably all you're going to get. So if you time it right, some of these small caps, RX, yeah, you can get a really nice sweet trade for a day or less than a day. But you got to monitor all of them because I don't know which of these have the most shorts. It's all dependent on how many shorts are in here, right? Like NVTS. Let's see. Let's look at this one. Yeah, see? It's just bouncing at the bottom. Like if there's a bunch of shorts down here, you can easily destroy them and they'll just fly up the like for a few seconds maybe. AOI is one that I told people to short. Well, it's just for a suggestion. And look at this. It's up 39%. So definitely this one in particular, it's easy to move up and it's easy to move down, right? So these things you got to be really careful. Like you got to get it in at the right time to short. Like here, I was saying on Friday, February 28th, I said this looks like a good short. And the next several days, trading days, it just goes down, and you hit a point where it's probably like logical. It makes sense. This was actually the last high in August. So that makes a lot of sense why it would stop there. And the market is turning. So once that boat turns, these little small caps, these little tugboats, little dinghies, they can rally really quickly, right? Just all the way back up. Now you're thinking, well, when should I short something like this again? That's what you should be thinking. So that's why all these little stocks, yeah, you can have a whole list of them and see what you can play. Okay. All right. Let's see. Gold. EXK. Yeah, I didn't do anything on Fridays for silver. No gold, 1% on the miners, nothing. So no big news on gold for Friday. We'll have to see on next week then when Powell talks. All right. I think that summarizes everything I needed to cover. But yeah, AOI definitely interesting, very interesting to trade. IONQ. Oh yeah. I might as well mention this one. Yeah, Skrelly loves to try to short this one, but you can see, right? It bounced at 18.68, and then it followed all the way up to this moving average here, the 18-day moving average. So let's see how that goes. So a lot of these stocks, very good. Oh yeah, this one's dead. Nah, this one's dead. Forget this one. Lunar, in interactive machines. Hymns. Let's see how this one's going. It's right back where we were in December. Yeah, I think this one's dead. Yeah, him's definitely dead. Don't bother with this one. How about AI? Is AI good? C3.ai. Is that one good? No. Damn. Yeah, it didn't really get a bounce on Friday, did it? Yeah, okay. Okay. Well, I don't know. I don't know which of these will make it. They all have different moves on Friday. You can't really tell. Monday's gonna be a different one, huh? Asan after earnings. Ugh. Yeah, maybe you can get the 16, 17 briefly and then fall back down. Yeah, sure. Maybe. Possible. Earning economy. Chris Reed says, Mr. GetCrack, I really appreciate the great information. Is Elon Musk hurting the economy or helping it? What's your thought? I keep hearing mixed opinions on what he's doing. So I don't think that's the big question right now. I would say, like, if you do a lot of government cuts at one go, it's definitely gonna shake up how the GDP looks like in the next couple quarters. But that might not matter if Jerome Powell starts cutting like crazy, because the estimated rate cuts right now are going back the other way. We're estimated to do 3-4 cuts right now, when we were like maybe a month ago they said we're only going to have one cut. So I think it really depends on how fast Powell changes his mind. The other problem too is the bonds. So Bessent is the Treasury Secretary. He's going to start changing things around August. That'll be the next big change in how many bonds get issued. That will be a big deal too. Any long-term effect from Elon? Yeah, we'll have to see. But short-term, yeah, you'll probably see it pretty shortly, because I'm looking at the unemployment and confidence numbers for employment. It looks like it's going to be pretty bad. Here, let me play this one. Let me play this video for you. I'm going to play a Debbie Downer guy. All right, I'll play this Debbie Downer. This is Jeffrey Gunlock, the Bond King. I wasn't planning on playing it because he's such a downer. It just brings down the mood. But okay, I'll play a little bit. The section.
Welcome, everybody. Probably continue, perhaps, which has shown some signs of life recently, primarily as we saw rising at the same pace. Really distressing. Why this is because it's the unemployment.
All right.
We see that for much different from the hike cut expectations, and it was also way different from the 2-year Treasury, which is kind of the same thing as the coming back through the first 9 months. There was a lot of cuts being priced in, and we got a lot of those starting in September, and a lot of those started to get priced out. And now more recently, in the last month, we're seeing cuts being priced back in. So it's been a roller coaster ride of about one cut.
So if you look at this chart, what he's saying is that when we got into September last year, you see the market the bond market, futures market, they were thinking, oh, there's going to be a lot of rate cuts coming in. And then when we passed September, they started thinking, wait a minute. Powell's kind of changing his tune. He's caring more about inflation. So then they start taking away those rate cuts. And then you can see into December and January, that's where we were and how many rate cuts we were going to get, like essentially 0.3%. That was the only cuts. So at one point in September, we got all the way down to past like 0.9% in rate cuts. And now, as we get into February, when the stock market's crashing, look at it. Now it's at like 0.75 almost. That's how many rate cuts we're going to get. So the market's confused. It doesn't know. Okay, let's continue.
Down to about 8 cuts, and then back to 1 cut, and now it's coming back to more cuts. So this continues to gyrate. Here's the 2's10 curve and the U3, the headline unemployment rate, and we say that the movement in the yield curve, the 2's10 spread, suggests that the unemployment rate should be going up. It started to do that and then slowed down. So is kind of signaling further deterioration in the employment picture, and certainly Doge, if they do cut jobs and waste from the government, there could be a very significant effect on the unemployment rate going higher. We'll see if that matters.
All right, so as you can see, if we cut a lot of jobs from the government and they really stay there, then yes, that might be a problem with this, okay?
Because it's the unemployment rate, or because it matters less, because it's a targeted subsector of the economy. We'll see what happens with that. Here's the one that is still signaling recession. This is the unemployment rate versus its 36-month moving average. And again, it looked like it was going higher, and then it stalled out. The moments in time that were most common to this one were back in the other peaks of risk assets, back in 2000 and back in 2007, 2008. This one is flattened out a little bit more than those periods, but we haven't gone on that huge acceleration yet, at least, that we saw in the aftermath of the 2007 experience. I'm going to go to some economic charts that show some real change just on a year-to-date basis. The first is on the screen now. The Conference Board expectations for fewer jobs in 6 months has just gone straight up. Maybe this has something to do with the Doge agency, but is taken out the prior peaks going all the way back 10 years and further. And we haven't seen an experience of it going up this much this quickly since about 2010, 2011. And that's when the people were talking about the credit rating of the United States being at risk, and we were talking about government shutdowns, and there was a partial downgrade of Treasury debt by one of the rating agencies, which I thought was silly and still do. But we didn't get a recession at that last spike, so we'll see what happens this time. But this is a really big shift in a short period of time. And here's the forecast from GDP Now, from the Atlanta Fed, which was clipping along at a 2.5 sort of a range. And you'll notice that the blue chip economists were in agreement with GDP Now earlier this year. And then all of a sudden, with this tariff saber rattling going on, we see that we've seen tremendous economic distortions, and one of them is real GDP for the first quarter, which is now estimated by the Atlanta Fed to be negative 2.5. We haven't seen a number like that in a long, long time. I don't know exactly why this has changed so radically on one day.
Well, that's interesting because like another dude from Double Line, like he was essentially, I played the video. He essentially said the reason this is happening is because a lot of companies are pulling forward their purchases because they know tariffs are coming, or at least they assume tariffs are coming. So they're going to buy everything ahead of time. And this causes a huge amount of imports versus exports. And this causes this number, the GDP Now estimate, to go down. Okay, so we have a lot of things, a lot of indicators signaling wild moves. Yeah, we got to be aware of them.
That big downgrade to about negative 1.5% happened in a day. So we're going to be following this quite closely. Here is something else this is also a disturbing trend, but one that's not new. This is federal deficits by fiscal year, and the fiscal year starts in October. And you'll notice that sequentially every year we are getting further into the deficit problem with fiscal deficits going up. So 2021 was bad, 2022 was worse. 2023 was, when it came to the fullness of the year, the worst ever. And 2024 is off to a very troubling start. So hopefully we get somewhere with cutting some of these, many appear to be fraudulent programs that the government seems to be totally willing to put in place and keep in place. And we'd like to see those go away, of course. It appears that the level of misallocation of government funds is very hard to overestimate. Here is the monthly coupon issuance by the Treasury Department going back to 2007. And this is kind of interesting. You'll notice that the massive mountain of issuance in response to COVID, with all of that money printing, has been matched with the mountain of borrowing that we've had in the last year. And so will this go to a new record? I certainly hope not. But it's really distressing that in what's perceived to be a growing economy, that the amount of debt is the same as the most spectacular response from a fiscal stimulus and a money printing situation. We're at the same amount of debt now being issued as we had during all of that $7 trillion of money printing. This is a chart I haven't ever used before, but I think it's really interesting. What we have is the budget deficit versus the unemployment rate. And so the budget deficit as a percent of GDP is on the y-axis and employment rates on the x-axis. You can see that the trend from 1960 to 2017, so that's the trend line through the black dots, was pretty understandable. When you had a high unemployment rate, you had a high deficit to fight it. And when you had a low unemployment rate, you had a low deficit relativistically, or even no deficit for some of those years, and a surplus instead. But now look what's happened. 2016 through 2024, what we see is that the unemployment rate is at the left-hand side of the x-axis, but the budget deficit is at the bottom, near the bottom. So the highest, since it's inverted, one of the highest percentages of GDP, running at 7.2%, and we haven't had a recession yet. So I know I talk about the deficit a lot. I'm not going to dwell on it a lot this time. I'm anxious to see if we can actually address the budget deficit. I had a question in the queue, which was almost like, when did you stop beating your wife question? Someone said, do you still support everything the Trump administration does? Well, I never supported everything the Trump administration did. I didn't like the state and local tax deduction cap. I didn't like the tax cuts that Trump put in place. I don't like a lot of things that every administration does. So we'll see what happens. I do support the Doge thing. I would like to find at least $1.5 trillion of cuts. We'll see if we can find that. It seems like a large, pretty heavy lift. Here's the headline.
All right, I think that gives you an opinion from one guy about Doge, Elon, and whatever. I all-seeing guy. Yeah, that's how it works. You gotta buy a new phone every other year or something now. That's how it works. Update it. Otherwise, how does the economy keep going? You gotta keep doing that. Buy. That's consumerism for you. That's how it works. Okay, let me give you a more upbeat video instead. All right, so and anything else I gotta talk about? No, I'll play this more upbeat one from Larry Williams. Larry Williams, the great Larry Williams, who won trading contests and all that. So I'm gonna let him tell you what's gonna happen in March, because he did predict at the end of December and early January, he was like, March will be the time to buy. So let's see what he says now.
Hi, fellow traders. This is Larry Williams, and I think it is rally time. Quite a few reasons why I think it's rally time in the stock market. Let me share those with you. First of all, I think the market is now undervalued. I don't mean oversold or overbought. I think it's undervalued, and I'm going to explain that. My valuation measures are on stockchart.com. Probably the most fascinating technical tool I've ever come up with. I think you'll enjoy that. Also, smart money has begun buying stocks in there. I'll show you where that's been taking place. And you know, you can have a good stock, but if you don't buy it at the right time, you can still have problems. So I like cycles and seasonals and a few other things to say right here, right now is probably the right time. So here's my longer term cycle in the stock market. I thought you'd appreciate this. You can see we've had pretty good buying points at these lows in this cycle. And since we're in a bull market, we get pullbacks at the peaks. So where are we now is what's more important, right? You can see the lows have been, and here we are. We're right into a low about every 5-6 months. We've seen a low in the or buying point in the stock market. And that's where we are now. So I think that's one reason. Timing says it's just about now. But again, timing might be off if you don't have a fundamental condition, a real reason to be a buyer at this point. So let's look at those real reasons. It really starts with my 2025 forecast report. Now, I know a lot of you have this, some of you didn't, but this was our forecast that starts at the first of the year, and we forecast it would come down until about the middle of March, and then we start to see this turn up. So this was our forecast made last December. The forecast report isn't available any longer. I'm just showing you, see, we had a pretty good idea the decline that we've seen was going to happen, and now this has turned up. And there's a little more to it than that. Like I said, my valuation model is really interesting to me because we can find when a market is undervalued. This is in stockchart.com called will value. You can see we're undervalued here. We're undervalued in this area. We're undervalued over here at a great point.
Sorry about that. Looks like StreamYards has effed up again. Let's see. Hold up. Oh, it doesn't? All-seeing guy, you don't. Your laptop doesn't have a USB-C power charge port. So I think most of laptops built around maybe not most. I don't know, actually. Never mind. But yeah. I mean, oh man, I'm not 100% sure, but I think a lot of laptops by now they just use USB-C to charge their laptop. So you can just use a power bank that has enough of wattage. You need enough wattage. So like an Anker, Anker, Anker. So if you get a power bank that has a lot of wattage that comes out of it, you can charge up your laptop. I mean, I have a dozen of those things. I just use them wherever I go to charge up stuff. So you can charge your phone and your laptop at the same time if it has a USB-C. That's it. You need to have a USB-C power port. So it's got to go. And if you're using an Apple, I think they have a Thunderbolt, which is equivalent. So if you have an adapter from USB-C to a Thunderbolt or whatever they call that thing, not Lightning, I'm talking about Thunderbolt. So that's their equivalent. So yeah, you can run your laptop off of that. Anyway, hold on, guys. I gotta get this video running again.
Valued in this area year, and we forecast it would come down until about the middle of March, and then we start to see this turn up. So this was our forecast made last December. The forecast report isn't available any longer. I'm just showing you, see, we had a pretty good idea the decline that we've seen was going to happen, and now this has turned up, and there's a little more to it than that. Like I said, my valuation model is really interesting to me because we can find when a market is undervalued. This is in stockchart.com called will value. You can see we're undervalued here. We're undervalued in this area. We're undervalued over here at a great point to be a buyer in the COVID crash. So we can find other periods. And what's interesting to me, you might even see price at relatively high levels, but we're undervalued in the market. We're undervalued over here. We're undervalued here. That's significant to me. These are times when I want to be a buyer in the market because prices have become undervalued and they will rally at some point in the future. We can see the last time we were undervalued was last September. Price was only down for a week, but we definitely hit the undervalued zone. So it's not an overbought, oversold indicator. And look where we are now. We've entered the undervalued zone as we did here, as we did here. Now, this is not a timing tool. Don't be misled by that. It's just a suggestion that we're in the value area of stock prices, and given being in a value area, then we can look for a trend change or an entry technique. But we have one condition that sets this market up as a potential area to rally. But I also like to see smart money has come in. I have my money flow index. That's also in stockdress.com. And we'll go back in time. You can see when they've started to buy. You see the professionals start to buy in here. The market rallies. They start to buy heavily in here. We rally. And again, it's so interesting to watch these professionals. We're really at a high price level here. Not much of a pullback or a dip in the market, but they were big buyers just before the run up, before the COVID crash. And right at the COVID crash, they moved to the buy side again. So I do think that money makes the world go round and certainly makes stock prices go up or down when they become sellers in the marketplace. So that's another reason. And if we look at recently what's gone on in the market, look how big buyers they were back here. And they were buyers at the lows, which are usually pretty correct in accumulating the market. Now, this is where they are now. They've just begun to get what I think is a sweet spot of their buying. A lot of buying came in as we saw a lot of buying back here. So this is another reason. Not only have we seen some valuation in this market, we also see that smart money has started to move into this marketplace. So the flow of money, they started nibbling in here. They really become much more aggressive buying or accumulating. Now, they don't just buy and try.
Oh, router won't work when the power goes out. Oh, you don't have a UPS? Yeah, you got to get a UPS, I guess, if you're going to do that. Yeah. Yeah, you must live in a pretty rural area or something. Yeah, that's not going to. Well, I don't know if like the cell phone towers will work or not. That's always going to be bad. That's always going to be bad. But in any case. Oh, look at that. Look at that. King Chenard's back. King Chenard's back. Oh, man. Hold on. King Chenard's back. Yeah, no shit, King Chenard. You're telling everyone to buy puts for the whole goddamn months, man. Look what I drew. I drew this shit. My purple line matches a line right to the damn thing. God damn. Oh, too bad, King Chenard. I'm already ahead of you, I guess, man. My fake ass drawing lines when I randomly draw lines on charts. Fuck, man. They get so accurate. Yeah, you can go back and see when I drew this one. Yep. Damn. Perfect. Exactly right. Right into March, right? We got March. Ides of March, man. Sorry. Anyway, you can do whatever you want. Everything's on record, man. Everything's on record.
In a day or two, they accumulate their position, and that's what I think has been going on in the market at this time. The other side of smart money is what we could call dumb money, or my advisor sentiment index. This is something I first wrote about in a book for Bloomberg 25 years ago. Still the same data, same stuff. We're looking at when the majority of advisors are really bullish. Look what happens in the marketplace. When the majority are really bearish, look where we are in the marketplace. The majority of advisors are really bearish. Well, that's the time usually to be a buyer. Here's a good example. The majority of advisors were saying you should be a seller here. In fact, you should have been a buyer. And where we are right now is about the same place. The advisors have become very bearish. Oh my gosh, you turn on the internet, anything, and everybody's bearish these days, right? Everybody's afraid. Well, that's one thing that's hard to learn to do, but you got to do it. You got to buy when it feels like you shouldn't be buying. And this is a good reflection of those emotions. When most people are bearish in the market, we're going to get at least some type of bounce in the market. The magnitude of that bounce, though, can come from the fundamental setup, like we looked at, the smart money buying. Is value in the marketplace, or the time cycles there as well. So that's how I like to kind of combine all this stuff and put it together. So with that in mind, the real problem, I think, is Wall Street is terrified, right? Donald Trump and the tariffs. What is this going to do to the market? That's been the real driving force here. And I think there's an answer to that I'd like to share with you. In part, tariffs began where I am here in St. Croix in the beautiful U.S. Virgin Islands. Alexander Hamilton came from this little island and went to Washington, D.C., was our first Secretary of Treasury, and had big tariffs. His idea was that if we could make it in America, have big tariffs on it. If we couldn't make it in America, then no tariffs on it, and use tariffs as we did to fund the government until about 1913. There was no income tax. All of the government revenue came in from tariffs. So what tariffs may do is increase prices, but they will increase jobs, because if things have a high tariff on them, we won't buy them from China or whoever, we'll make them here. So we should see an increase in the job market. We may see increase in prices, but, and of course, more jobs is really bullish, but this drill baby drill thing is really interesting. This
Oh, sorry about that. Yeah, StreamYard's going like a little. It's still flaky, man. StreamYard's. All right. All right.
is Larry Williams, and I think it is rally time. Quite a few reasons why I think it's rally time. Like we looked at, the smart money buying is value in the marketplace, or the time cycles there as well. So that's how I like to kind of combine all this stuff and put it together. So with that in mind, the real problem, I think, is Wall Street is terrified, right? Donald Trump and the tariffs. What is this going to do to the market? That's been the real driving force here. And I think there's an answer to that I'd like to share with you. In part, tariffs began where I am here in St. Croix in the beautiful U.S. Virgin Islands. Alexander Hamilton came from this little island and went to Washington, D.C., was our first Secretary of Treasury, and had big tariffs. His idea was that if we could make it in America, have big tariffs on it. If we couldn't make it in America, then no tariffs on it, and use tariffs as we did to fund the government until about 1913. There was no income tax. All of the government revenue came in from tariffs. So what tariffs may do is increase prices, but they will increase jobs, because if things have a high tariff on them, we won't buy them from China or whoever, we'll make them here. So we should see an increase in the job market. We may see increase in prices, but, and of course, more jobs is really bullish, but this drill baby drill thing is really interesting. This will lower inflation. If Donald Trump is correct and he's going to really open up the gates of oil, and that's what he talks about, who knows what will happen. But if that does happen, that's going to lower inflation, which, as I see it, is an offset to tariffs increasing prices. So in terms of inflation, which has been the talk of everybody in economics recently, I think we're going to continue to see less inflation. Here's why. Inflation is really crude oil. The black line is the inflation index, sticky inflation. The red line is crude oil. Look how closely they go together, right? Price of crude oil goes up, inflation goes up. Crude oil goes to that I'd like to share with you. In part, tariffs began where I am here in St. Croix in the beautiful U.S. Virgin Islands. Alexander Hamilton came from this little island and went to Washington, D.C., was our first Secretary of Treasury, and had big tariffs. His idea was that if we could make it in America, have big tariffs on it. If we couldn't make it in America, then no tariffs on it, and use tariffs as we did to fund the government until about 1913. There was no income tax. All of the government revenue came in from tariffs. So what tariffs may do is increase prices, but they will increase jobs, because if things have a high tariff on them, we won't buy them from China or whoever. We'll make them here. So we should see an increase in the job market. We may see increase in prices, but, and of course, more jobs is really bullish, but this drill baby drill thing is really interesting. This will lower inflation. If Donald Trump is correct and he's going to really open up the gates of oil, and that's what he talks about, who knows what will happen. But if that does happen, that's going to lower inflation, which, as I see it, is an offset to tariffs increasing prices. So in terms of inflation, which has been the talk of everybody in economics recently, I think we're going to continue to see less inflation. Here's why. Inflation is really crude oil. The black line is the inflation index, sticky inflation. The red line is crude oil. Look how closely they go together, right? Price of crude oil goes up, and line is the inflation, which has been the talk of everybody in economics recently. I think we're going to continue to see less inflation. Here's why. Inflation is really crude oil. The black line is the inflation index, sticky inflation. The red line is crude oil. Look how closely they go together, right? Price of crude oil goes up, inflation goes up. Crude oil goes up, inflation goes up. I mean, inflation is crude oil is a huge part of the inflation data. Here we see that relationship 2007 coming forward. Crude oil goes up, inflation goes up. Crude oil comes down, inflation comes down. I mean, they're just sister and brother with one another. Not always, occasionally we see a little divergence, but by and large, the cost of crude oil is the main driver of inflation. And here's where we are right now. what I've actually done in these charts I just showed you, I push forward crude oil prices about a year in advance because crude oil actually predicts in advance inflation. This is, notice that we had a big increase in inflation here, but this crude oil data in red was known a year and a half in advance. Just like now we see, oh, crude oil is over here. It's been continuing coming down. That suggests inflation is going to continue coming down. So if you really want to get a good idea of inflation, well, if we have a massive rally in crude oil, yeah, we're going to inflate. But at this point, right here, right now, it does not look like that's going to happen. So we have a pretty good idea just looking at the relationship of inflation to crude oil that we're going to continue to see lower inflation. And maybe more important, as I see it, is that if we do drill, baby drill, there will be more oil. And whenever you have more of any commodity, what happens to prices? Prices go down. You're going to have essentially the same demand, but more quantity. So prices will decline, which means less inflation, which I think is a positive for the economy, for us as buyers and sellers, and for the stock market itself. So drill, baby, drill. This is going to be really interesting to watch to see if they really do drill, baby, drill, because if they drill down, you're going to see inflation go down. So we can also look at the relationship of crude oil to stock prices. I'd like you to look at this closely. Again, we're seeing crude oil in red and we're seeing stock prices in blue. This is the crash of 1987. Look what happened, that big rally in 87, big increase in crude prices, and then down came crude. Down came the stock market. Then crude started to rally, stocks started rallying. Crude started to come down and stocks followed suit as well. So there is also a relationship between crude oil and stock prices for obvious reasons. Here we see from 1998 into 2002. Remember, the stock market topped in 2002, 2000 went down a lot, the S&P even more. Well, look what happened to crude oil prices. At the end of 1999, crude oil prices started to come down, and that big bull market stocks have been in turned into a big bear market. Look at that. What a relationship between these two. I mean, fundamentals do cause things to happen. The market's not, as I've always said, charts don't drive the markets. Conditions drive the markets, and this is one of the leading conditions. Here we continue seeing this, as I'm going to explain a little bit more about this red line, which is crude oil prices in a moment. There's a crash of 2008. The market, crude oil came down, stocks followed, crude oil went up, stocks followed. Pretty good relationship. And now what I've been doing again, I've been pushing forward the price of crude oil, in this case, pushing the price of crude oil forward by about a year, a little over a year. And that's been a really good sign of what's going to happen to the stock market. We'll up and bounce around. Look at the decline we've had in stock. Yeah, there it is in crude oil. And now we should start to see a rally. So this relationship of crude oil and stock prices, I think, is good. I'm going to blow it up for you a little bit so you can see a better relationship to it right here. So this is where we are right here, right now. And this is saying crude oil also suggesting for us a potential rally in the market. So another real reason, just as we saw a rally back here, just as we saw this rally, saw a rally back here, a real reason for stocks to have a rally at this time. Now, what I've done here, this is one of my little secrets I'd like to share with you. Crude oil prices inverted. So when you see the red line here, this is crude oil turned upside down. In other words, crude oil was actually not rallying here, it was declining. So there's an inverse relationship between these two. So keep in mind that what you've seen is crude oil prices inverted, and when they're inverted, they lead stock prices. So this is just one more little arrow you can add to your quiver to help you understand the market, to look at these relationships between stock prices. And really, the most important thing in the world right now is crude oil. You know, the golden rule turned to be black. The golden rule used to be who has the gold rules, right? That's changed. Here's a simple question. How long can you live without having gold? How long can you live without having crude oil? Well, you can live probably the rest of your life or for a long time without having gold. But what happens if we don't have any crude oil in the world? We have a world of problem. The cars stop, the machinery stop, the airplanes stop, the trucking. Well, we're in a world of hurt. So this is why crude oil is so important and such a critical part of the economy, and why it has such an effect on stock prices, inflation, and just a concomitant relationship across the board. So we really have to focus on this as a driving force of the economy of the world. So we can also look then at black gold and yellow gold. I think you gold people enjoy looking at this. The yellow line you see is obviously gold prices, and the black line is crude oil, black gold, right? Crude oil. And you can see again, pretty much they dance the same tune, don't they? Black gold goes up, real gold goes up, black gold goes up, real gold goes up. They come down together, they go up together. So there's a relationship there that you as an investor or a trader can also take advantage of in whatever you're doing. Here we see it into 2020. Black gold went up, gold went up. Black gold came down, gold went down. Black gold went up, gold went up. Okay, so we get to see that relationship. And it's a powerful relationship that's been there a long time. This is where we are right now. I'm bringing this up to date for you. Black gold started to go up late 2022, and gold started to come up. Black gold got really strong. Gold really picked up to the upside. So I know what you're thinking. Where are we right here, right now, Larry? Well, it looks like we get choppy, but around 615, this relation, which is another inverted relationship, shows that again we start to see gold move back to the upside. It looks like gold should make new highs in here. So this is an early June, middle of June, we should start to see another really good buy point. We can look how closely this has happened in the past. There was a forecast buy point. No, look at that. Known 6-7 months in advance, right? Remember, gold prices here are lagged, or in other words, crude oil prices and black are pushed forward. So we knew about this in advance, just like we know about this now. We know about this now. These points, this is critical for your understanding. We're known in advance. The problem most of us have as traders, we really don't have a good view of the future. Like we look at a chart, we don't know if it's going to go up or down, or we might have a bias, emotional or intellectual bias. But here we say, oh, I got it. This is what most likely will happen in the future. Because really, as speculators, we need to live in the future. You can't think about today. You have to be living, I'm living out here. How's the rest of this year going to finish? What's going to happen? I'm living out here, and I can see from the forecast of crude oil a pretty good idea what's going to happen to gold. Again, crude oil is inverted. All the crude oil data that you see here has been inverted. In other words, it's been turned upside down, where it looks like it's been rallying. No, crude oil was going down during this time period. So you need to understand that if you're going to look at the relationship of these items. Well, let's get more about, okay, it looks like a lot of good things might be happening, Larry, but is it time? And I think we are in a bullish wave. This is part of my cyclical studies. This red line shows a wave that really kicks into the marketplace. You can see it kicked in here, kicked in here, kicked in here. It's been pretty reliable. Here's September 2021, it kicked in. Just at the lows in 22, it kicked in again. And again in 2023, last year it kicked in again, and this is where we are now. At the end of this month, this red cycle kicks in. Typically in the past, prices have rallied about 80% of the time when we've seen this wave. Now, it's not a cycle. It's hard to say exactly what this is, but it's a wave that continues to drive prices in the market. And this wave is just about where we are now. So we're getting into the end of this month, we should see this bullish wave kick up into prices as we've seen it in the past. Will it call the absolute low? No, but does it get a good idea of when to start to look for a rally? Yeah. And it's saying that we're just about there, the middle part, end of this month. We're almost in the middle of March now. Should be a time to expect prices to rally. So I think it's rally time. So there's some stock we might want to look at. One would be Tesla. If we look at my money flow index, we see that smart money, which is buying Tesla back here and over here and here and here and here and here and here, right? Look what, they just started buying Tesla again. So you can go to stockcharts.com and you put in our money flow index, you see when big money started to buy. So that's one reason I think that Tesla could rally now. If we also look at the seasonal pattern in Tesla, it also started to turn to the upside just about the middle of April last year, year before. So we have the seasonal starting to get bullish on this market, and we see smart money has started to buy. We can also look at my valuation index, and we see Tesla is undervalued here, as it was undervalued here, as was undervalued here, and undervalued back here. Now, I know there's a lot of news about Elon Musk and, oh, he's going to destroy the government or save the government. I don't know what's going to happen. They're going to throw out some good babies with the bathwater and all this cutting, that's for sure. But when I look at the conditions of the stock, I see what I like to see. Undervalued. The right time is coming soon. And we've seen smart money start to buy the stock. That, to me, sets it up as a buy point. Here's another stock you might want to consider. This is an ETF, XLP. XLP is consumer staples. It's a group of consumer companies. Let's see, here they are: Procter & Gamble, Costco, Walmart, Coca, all the things that we all eat and use and shop at, right? That's what's in XLP. Now we look at my cycle forecast in XLP. It suggests we're coming into a low. We see that it's in an undervalued zone as it was back here. And professional money was buying here. They're not quite aggressive buyers yet. Maybe after this week they will be, but we're starting to see this market get set up as well. When I turn my cycle machine, I see we're also getting, the first part of April, we're getting into a low for XLP. So this is another market I think you want to consider. And again, when we get into this zone, this blue line, we have about an 80% probability of rallying from somewhere in the middle of April, 1st of April into September. So this is another stock I think you might want to pay some attention to as things progress. Okay, so let's take a look at what they own. Those are the companies that XLP is invested in. You don't have to buy Coca-Cola or Walmart or Costco. You could buy this stock, and you're effectively going to have a position in all of these stocks. That might be an easier way for some people who want to be in the consumer goods section. And I think this section probably will not be as much influenced by tariffs, because some of these are, but Coca-Cola is sugar, and they're making Coca-Cola and beverages, right? Philip Morris is now basically Altria food company. PepsiCo, again, food company. Mondelez food, Altria food, Colgate, Palmolive, soap and stuff. Not a lot of things that we're importing with high tariffs on them. Target maybe a little differently, maybe Costco, but by and large, this group I don't think will have as much of an impact on tariffs or higher prices, which might result in lower sales. NVIDIA. This is a stock last year everybody wanted to own. This year nobody wants to own. So where are we right here, right now with the stock? It just started to become undervalued as it was back here. It was close to undervalued back here. So here's another stock that's a lot of people have been following it, some for the wrong reasons, but we're starting to see it get set up as well. So what's professional money been doing it? What's the funds been doing it? There are big buyers up here, and they just recently started to buy it again. So that's a bullish consideration for us to consider. Those who are, a lot of you are in NVIDIA and going, oh, what am I going to do? Well, you have some hope here. You have some relief for this stock now, because we're starting to see undervalued and professional money coming into this marketplace. We can also look at the seasonal pattern here. The seasonal pattern, we should rally a bit and then take off the middle of April. That's what usually happens. Now, this is what I want to point out to you. Look at this carefully. The red line, notice NVIDIA is lower here than it was here. Most stocks are lower now than they were back in January. That's most stocks. The stocks I want to buy are the ones that are higher now than they were in January. Those are the ones that attract me the most, because they held up the best on this recent decline. You may have noticed back here when we were looking at XLP, it's higher now than it was back here. So it's held up better than, say, NVIDIA, right? Which has come down. So I want to look for the stocks that didn't get beat up. That's one of the criteria I look for. So we look at ASML, which is about the same business as NVIDIA. Oh, it's held up much better, hasn't it? So you might want to look at that in terms of your stock selection or your own stock screening. Which stocks in this recent decline held up the best? The ones that got beat the most, they might have a bounce back, but obviously they were in stronger hands. This was in stronger hands coming down than NVIDIA was coming down. So I like to buy stocks that have been in strong hands. We look at Apple right now. Apple just kissed old lows. It was stronger than NVIDIA. NVIDIA, remember, most stocks are a lot lower now than they were here. So Apple also has held up comparatively better than the average itself. And it is at a cyclical point when we would expect this market to rally based on the seasonal pattern in the stock market. So that kind of wraps up what I see in stocks here. I think the big thing is coming up is what could cause this rally. What's going to ignite it? And I think it's going to be this. The war in Ukraine will end. That Donald Trump will negotiate some type of agreement between Ukraine and Russia and maybe NATO, who knows, and the US. And I think that is most likely going to be the trigger mechanism to see things like Apple start to move back to the upside, just because it's an emotional setting in the marketplace, like, oh, something got accomplished here. So I think that's the most important news to pay attention to. But if we look at my cycle forecast, remember, they're all saying we should rally right here, right now. So I think the news will come out and just justifies what the cycle has already told us. So to wrap this all up, I think it's rally time. And I think it's rally time for fundamental reasons, for technical reasons, for cyclical and seasonal reasons. I hope you've enjoyed today's presentation. I hope you've learned from it. There's so much to learn about the markets. It's really my privilege to share what little I know with you. And thanks again to StockCharts.com, because they made all of this possible.
Alrighty. Okay, we're done with that. So I'm gonna go over to some old man, some boomer. You're gonna learn some old stuff, some really old stuff here now. Let's go here. Hold on. Let me read this article I read a long while ago, a month ago, actually. Okay. And this would have been a warning sign to you back then. So let's read this. NYSE AD line divergence. And this was written in January 23rd, 2025. And I read this little article sometime back then. That was like over a month ago, right? The S&P 500 on January 23rd, 2025 was able to climb up to a new all-time closing high, but it is not yet dragging along the rest of the market. And this may indicate a problem. This week's chart shows a bearish divergence evident in the NYSE, New York Stock Exchange's cumulative daily advanced decline line. The divergence is that the S&P 500 is making a higher high, but the NYSE AD line is not yet confirming. The AD line is a cumulative running total of the daily difference between the advancing and declining issues meaning stock, equity. If more stocks are going up, then the AD line goes higher. Divergences like the current one can be really important, as we saw with the one which developed at the end of 2021, right here. Well, we know what happened after this, don't we? Right? We know what happened after that. So, divergences like the one can be really important, blah, 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 developed at the end of 2021, shown at the left end of the chart above. But divergences can also get rehabilitated if the diverging indicator makes up the difference and goes higher. That is possible. That didn't happen. One important point is that a divergence represents a condition and not a signal, right? So the reason why analysts pay so much attention to breadth indicators like the 80 line is that most times they will do whatever prices do, and sometimes they give a different answer. And that difference can be important. Big cap price indices like the S&P 500 are dominated by a handful of large issues, right? Tesla, NVIDIA, Apple. Whereas the 80 line is more egalitarian. Every issue gets an equal vote. When liquidity starts being a problem, it tends to affect the smaller and weaker issues first, before eventually coming around to bite the rest of the market. You got bitten. So watching to see what all of the issues are doing as opposed to the currently fashionable large stocks can tell us about the health of the liquidity stream. That is why the NYSE's AD line is one of my favorite indicators to get that message about liquidity. Okay, now I read that because I'm going to play this video here. So this was a presentation done a while ago. It was played today at the Foundation of Study Cycles. So you'll hear it from the horse's mouth. So McClellan writes these articles, Tom McClellan. So you'll hear from his father. Okay, this time around, this video. So he's going to talk pretty slow. You know, these are boomers. This is a super boomer.
Today with a great friend of the foundation, Sherman McClellan, widely known to everyone in the technical analysis community, and I'm just very happy to be having this conversation today, have the opportunity to have this conversation with you, Sherman, and to share with the followers of the foundation some of your work and some of your history in the markets and your history with the foundation as well. So thank you so much for joining us today.
Well, we're glad to be here, and we've done work with the foundation for quite many decades.
I was looking at your background, Sherman, and noted that you actually did your academic work in business and economics.
That's correct.
And was that at Claremont McKenna?
At Claremont Men's College, which has now been integrated with women and is now called Claremont McKenna College. Yeah, but there were about 4 graduating classes where there were women graduating from Claremont Men's College, and the college offered them a revised diploma with the Claremont McKenna, and I don't think any of them wanted it. I don't think anyone of them took it up on. They were really happy to be a woman graduating from a Claremont Men's College.
All right, I'm going to go forward in this video. So all the links you can get yourself, okay, in the description. But I'm going to forward this to here when he starts talking here. Okay, get into the details.
Came out to Irvine, and then they had meetings every month. And we went dinners, and so we'd come and have dinner and have a presentation by different people, and mostly by Richard Mulkey. And and then they moved back to Pennsylvania. Well, that was our people. We had about maybe 40, 50 people that really enjoyed getting together. So we continued with the West Coast Cycles Club after that.
Right. So you're still basically continuing that tradition today with the West Coast Cycles Club. Is that right?
That's correct.
And so if anybody is on the West Coast who wants to...
We're doing it online now. So anybody can join us on the last Tuesday of the month at 1 o'clock.
Absolutely. So I know you've prepared a few slides, Sherman, and it would probably help to get some visuals at this point. So
let's do that.
So we can look more closely at the indicators that you developed and, of course, what they're showing about the markets today.
All right.
What a great picture.
That's
beautiful.
This is the team that it took to, neither one of us had all of those tools and the knowledge and of what it took to create the McClellan oscillator and summation index. It took calculus. Those indicators are calculus for people that never got to that stage. And the summation is the area under the curve, and there's second derivative, and that's stuff that I don't even know all about. But it took her abilities in the math and took my abilities with the market and economics and how we could do it. Here's the advanced decline line.
Yes.
that this famous advanced decline line. And here's we had on the left side of the chart, there's some negative action in the 2015-16 area. And then it took off and had a very long run up above the 1% trend there, the blue line. And then a correction in 2018 when the Fed was having quantitative tightening, and the little bump right in the middle down to the blue line is the crash for COVID, which
Is that something you can put your cursor? Can you put your cursor on that, Sherman, on the screen?
Right here.
Right there. Okay.
That's the 2020 COVID crash.
Okay. So just to be clear what we're looking at here. So I think in the black, there's actually two different lines there, right? First is the literal cumulative advanced decline line. So it's the number of advancing issues minus the number of declining issues. And then you just, add that number up from day to day, right?
Right.
So let's say right before the COVID crash there, it looks like it was at about 480-ish, right?
Yeah.
And so that means that
1,000, I think it is.
480,000, right? So
but the scaling is just our arbitrary where we started with it.
Mm-hmm. Yeah. Do you remember where you started with it, or does it matter?
I don't know.
Okay.
Probably zero.
All right.
I don't
but
know.
There's also like a kind of, I think the 5% trend line is in there too, right?
Yeah, they're all mixed up together because this is a fairly tight chart.
Right. And so the 5% of trend, can you talk a little bit about these percent trend indicators? Because they're not exactly moving averages, right? What does it mean to be?
They're called exponential moving averages.
Okay.
And the 10% trend moves 1/10 of the distance between today's value of advances minus declines and wherever the previous day's number is.
Okay.
So if you had 100 more advances and the previous day was 0, it had moved 10 points.
Mm-hmm.
And the 5% trend would move 5 points.
So the 10% trend is kind of a faster, the bigger the number, the faster
the 10% is equivalent to about a 19-day moving average.
Exponential moving average?
Just a regular moving average.
Okay. And how about the others, the 5%?
And the 5% trend is around a 39-day moving average. If you calculated a 39-day smooth moving average, it would be roughly equivalent to a 5% trend, but it wouldn't be as responsive.
And the 1% trend?
And the 1% is about 189 days, so it's very close to a 200-day moving average.
That's interesting.
A little bit faster than that.
All of them are just a little bit faster than some of the more widely used, numbers like the round numbers, right?
That's
so
correct.
You're jumping the gun just a little bit.
Now, there's one other thing I'd point out here. That when the advanced decline line is below the 1% trend, as it was here in 2022 and the bear market, it stays, the advanced decline line is basically below the 1% trend. So that's a bear market type of condition. And we saw it over here in the 2015 area to 16. And
so what is this telling us about the markets today?
But this large advance is quantitative easing and quantitative easing and quantitative easing and inflation. So this particular picture of the advanced decline line is not what the advanced decline line looks like under stable conditions, where it just goes up and down and up and down. And
Right.
we looked at the period prior to that, it would be a very different looking indicator. So,
Okay.
and then this last move up is very interesting because this top was made in November, and the top this year was a lower top, and so this created a divergence, just as we had created a divergence at this point before the bear market in 2022. So we have the setup for this to decline below the 1% trend, and if it does, it will it'll do away with the 10% trends, 10% declines in price that we've seen on some indicators this year, and it will look more like in the 20% or maybe double that.
So
next period.
earlier in our conversation, you mentioned that you were looking for ways to enhance the predictive power of the advanced decline line. Would you say that those kinds of divergences were one of the main tools that you found that you use?
It's one of the things that we've seen, and we've seen not only this divergence that I just pointed out, or the two of them, but we've seen it in many other indicators. There's about more like a half a dozen to a dozen divergences that are showing up.
So the way that you're using this, you're watching where it is relative to these three different trend lines.
Right.
You're also looking for divergences from price. So, price may have made a new high, but the advanced decline line did not make a new high.
Let me point out, I didn't show that in this presentation today, but this peak that we had in 2000, at the beginning of 2022, and at the end of 21, that peak on the weekly advanced decline line has not been exceeded. So this high was on the weekly advanced decline line was just below that peak. And so there's a huge divergence on the weekly advanced decline line.
That sounds concerning.
And I've drawn a trend line across the lows back to the COVID low. And that might be an objective for the advanced decline line over the next year and a half or two. And so if that is the case, the only way it can get down to that is by going below the 1% trend. And that requires a bear market. So that's not a possibility that we'll be watching to see if that is what we really get out of it.
So is this the McClellan oscillator?
The difference between...
Or is this just the advanced decline line, cumulative advanced decline?
The difference between this moving average and that moving average is the McClellan oscillator.
Gotcha. Okay.
And you can't see them on this chart, and I don't even have a chart of the oscillator itself, but I'll show you how the oscillator's numbers develop into the summation index.
And so why are you, if you go back to that chart for just a minute, so why did you want to look at the difference between the 10% trend and the 5% trend?
Because that's the value of the McClellan oscillator.
And what does that predict for you? What is
oscillator value is changed. The summation index is changed by whatever the oscillator number is.
Okay.
So when the oscillator is positive, the summation index is going up. And when the oscillator is negative and the 10% below the 5% trend, which is quite often, then the summation index is declining.
So the 10% trend is the fastest. And if
Yes.
it's above the 5%, then that oscillator value is positive. And the 10% is below the 5%, then it's negative.
That's the case.
And then you just add those up. That's the summation index every day when you kind of add those values up day after day after
Right.
day. And we haven't talked about the summation index yet, but
Right.
look forward to it.
So
So here it is.
here it is. And as you can see, there's lots of volatility in this indicator.
So we're
Yeah,
looking at
If the oscillator is positive, then the summation index is rising. And when it is below the zero line or the neutral level here, which is at 1,000, and that was originally we started with it at 0, but it was too hard to calculate negative numbers by hand for many people that wanted to follow it. And so we moved it up to 1,000, and it very rarely goes below 0. And when it does go below 0, which is really minus 1,000, that's a rare event, several years apart. And so you don't have to deal with it very often. And you only deal with that when the market is really in trouble. So,
so give us, tell us a little bit about what you see in this chart.
let me start over here at this. This is finishing up a very negative summation index, minus what is it, minus 1,000.
And that was in 2015.
And that's early 2016.
Early 2016. Okay. What was going on then?
And quantitative tightening was going on, and that created this condition for prices to be declining.
Right.
And then the Fed said, no, that's not what we want to do. We're going to have quantitative easing. So the summation index went up to a level above this horizontal dashed line across here.
What a wild swing.
Way up here, and it had very wide spacing of the dots as it advanced.
Wow.
And this shows initiation. And when it gets to a very high level, this is the beginning of an initiation for this whole advance. And then it went up above it again, saying, yes, we're really interested in going higher. And then, of course, as soon as that happened, we went down to the bottom again. But as it stayed above the neutral level here for quite a long time, it had quite an advance. And then we had a price high and a lower summation top, creating a divergence condition at this point. And that began a sideways market. And until
Can I ask you a question, Sherman?
Sure.
So if we go back to that first
this phase
acceleration right here, right? So you had the quantitative easing start, you had all of those, so every day more stocks were going up in price than going down in price, right? And that kind of really accelerated. What's fascinating to me here is how that acceleration peaked very early on in what was then a major bull market for a few years.
Right.
So what's making price go up there, if it's not, more stocks going up than going down, right? Like why does price keep going up, but the summation index doesn't keep going up?
Because the oscillator is measuring acceleration.
Okay.
And the summation index is being driven by that oscillator showing acceleration. And so it's also showing acceleration. And so this is an acceleration measurement. And then this positive action following is all momentum from that
Right.
initiation of an advance.
Right. And momentum is kind of like, I mean, going back to the calculus, the first derivative, and acceleration is the second derivative.
Yeah.
So the summation index is really showing us those times of acceleration that more than likely are going to lead to big trend changes.
And we have the same thing here in 2018, 19. And again, we had a very huge advance showing great acceleration. And indeed, we continued on up until 2020 from that. And within the summation index spent much time above its neutral level in rising bottoms. And then when it broke that rising bottom structure in COVID, it told you within a day or two that you had problems.
Right.
And the problem went on all the way down to here.
Oh my goodness. That's incredible.
So, and when that turned up again, that was the bottom. And then we had, came all the way up to here and had not a higher above it, but certainly up to the horizontal line here, showing that, yeah, this has legs on this move.
Right.
And
it's sort of the acceleration gets you up to a cruising speed, and then that cruising speed is your momentum.
That's right.
Going forward.
So this acceleration phase shows, don't expect that this is the end of things. This is the beginning of things.
Right.
And you want to look for where when it pulls back and turns up again from a lower level. You want to be involved with that on the long side.
Gotcha. And do you look at the distance between the dots? Do you analyze that? Like when you get those big steps?
The distance between these dots are what the oscillator value is.
Okay. And so when you see a big oscillator value,
large distance between, those are very high oscillator numbers, up around 250, 300. And when you see these large dots going down, those are minus 250, minus 300, minus 400.
Okay. Wow.
So those tell you that there is acceleration and power in that particular move. And
it's so helpful, Sherman. I'm understanding this much better now.
Now, when this whole topping structure here says very strong, because it remained quite a long distance between the bottoms and the neutral level. And so this reemphasized that this quantitative easing phase was still powerful. And then when it came down to below the neutral level and created a lower top, that top was associated with this first top. And then we had an even lower top, and that was associated with the top. And then you turn down right at the neutral level. And that's when this really got started on the downside in 2022. And then that finished out. We got this failed to get up to the acceleration phase that says we have continuation going. And we indeed turned down at a lower high than the previous high here and made a lower low. And then we got acceleration enough to get up above this dotted line. That's a separation from, that tells us, yes, we've got something really important going on. But it took quite a bit of time before it mattered. And it took the bottom in here and that created
That was the 22 bottom, the late 22 bottom.
This is the late 22 bottom.
Oh, okay, there it is. Yeah.
And this is the bottom in 2023, around September, third quarter, fourth quarter
Right.
of 23. And the advance, and that gave us enough that says, yes, this advance is going to have legs. And indeed, we stayed above the neutral level. And then we had a final push over here. And that push is about in the middle here, probably about here. And then this top in the fourth quarter was associated with this much lower summation top, creating a huge divergence. And then that came down and was supported on this uptrend line across the lows from the 2022 bottom. And it created a lower top in this year's top. And that the February top was a lower price on the New York Composite. However, the S&P 500 made a slightly higher top on February 19th.
Right.
And but well, along with the divergence, and it was the only indicator that made a higher high in 2025 than 2024. So we're coming down now, and we're still continuing to decline. And we'll find out whether this
And we're below the neutral line.
or whether it's going to go even farther down.
And we're below the neutral line, right?
Yeah, we're below the neutral line, and
Yeah.
how low is low? We're going to find out. We're still going down.
Okay.
We're down 400 points today on the Dow, 500 earlier.
My goodness.
So
Okay.
we're taking out this January low.
So and again, this is just on the New York Stock Exchange
The New York
Composite,
Stock Exchange.
because that is the index that has the
driving
most.
data that drives the McClellan oscillator calculation.
And you use the New York Stock Exchange because there's the least churn in that index. Is that right?
Well, it's the broadest index. There's like 1,500 issues in it or thereabouts.
Okay.
And there's only 30 Dow stocks, and there's 500 S&P stocks, and there's 100 NDX stocks. So
right.
We're interested in what the really broad market is doing. So that's why we use it as a comparison a bunch of the time.
All right. Well, that was a master class. Thank you. Did you have any other charts you want to look at?
Yeah, we're going to look at this one.
Great.
And this is the volume summation index.
Okay.
And it behaves slightly different from the AD summation index. Now, over here, we saw acceleration to a high level, saying this is an initiation.
Can I just
But
ask
confirmed
for
by the volume summation?
So it's the volume, like the
So we have up volume,
minus down
we have
volume?
down volume, and the difference between them is what drives the daily volume line.
And is that basically every trade is either, higher or lower? And
Well,
that's
for
how you
that
measure?
particular day, they close higher or lower, and if the price changes to, up, if the price is up for the day, that volume is all counted as
That's
an
up volume.
And
Okay.
if the price is down for that day, all of the volume going into those stocks
Okay.
is the down
Got it.
volume.
Got it. Thank you.
And so we use the same calculations of 10% trend, 5% trend to calculate the oscillator using just the volume data.
Interesting.
Summation index. So this is what the summation looks like for volume.
Okay.
So we get a good confirmation out of this, that this move from very early here has legs. And indeed, we had very small dips below zero on this indicator, and the neutral level is zero. And then as these tops had slight declines, it was losing some momentum, or showing a loss of momentum, but it was still very powerful. This part of it, we had a bumpy up condition where each high was higher than the previous one, rather than being lower as it would be in a strong normal. So this rising tops condition is a weak condition.
Oh, fascinating.
And as soon as
I wouldn't have intuited that.
Accelerated move up turned down, we see very large dots. So the very large volume taking place to the downside immediately. And this is like 1, 2, 3, 4, 5, 6, 7, maybe 8 days. So that's like a week and a half. You did all the damage. That's why we had to have something that told us within a day, approximately, that we have a trend change. So we can participate in that kind of a move.
Wow.
So that's why the oscillator is using exponential moving averages rather than just plain old moving averages.
So once you saw, 1 or 2 of those big steps down, you said, and you saw that there were kind of a rising series of tops.
Yeah, as soon as that turned down, we knew.
You said, got to get on this
because you're
elevator going down.
This high level.
Okay.
Although this line wasn't established yet, but it was established by these other tops. And it's in this vicinity of where tops are made on this indicator.
Okay.
And then this is 2018-19, which was quantitative tightening situation. So, and we came down to a very low level. And then we came back up and touched the line, said, yeah, no, this has got some legs. And it did until it got over to here. And then we had COVID. And this is the COVID crash. And we'd never seen this indicator go this low before, ever.
Yeah.
Maybe if it got down to here, it would be all done wrong. It had,
and look at those huge steps, the gaps in the oscillator are just
and this price low, of course, took out this low over here.
Right. No, I remember it well.
All of this advance that took place.
Unbelievable.
And then we had acceleration matching the advanced decline summation, showing above the dotted line saying this up move has legs. It's not all done. We're not just going to rally up here and fail. And we did. It took some consolidation, but all that is consolidation in the same area where it did before. And then it broke out with a new acceleration phase that said, yeah, we're going to do great things. We had declining tops, which says this is a strong market. And still declining tops until we got over into here. And then we spent a long time below zero. And in this 2022 bear market, until we started having increasingly higher tops, until we finally got an acceleration move above the dotted line that says, yeah, this is something that's more important. And so now,
it's so interesting to me, Sherman, to see how you can have the oscillator or the summation index below zero, which kind of means distribution is happening, right? There's more selling going on behind the scenes, even though price isn't moving down sharply yet.
Yeah, but you can see these large dot spacings on the way down.
Sure.
Those are very negative oscillator readings.
Yeah.
That changes. And this is why I didn't show the oscillator itself. It's a very busy indicator.
Mm-hmm.
And this shows what this distance between the dots shows what the oscillator number was very negative.
I was thinking more around kind of is that 21, 22 year there where price was still at its highs, but the oscillator, or the summation index was below zero. Yeah, right in there.
Yeah.
So you had that kind of, it's almost like stealth selling going on behind the scenes, even though
Right.
price isn't really
All
tanking yet.
of these declines continued going down,
Mm-hmm.
and until all of this negativity took place in
Yeah.
distribution.
Yep.
And
Interesting.
now we have an uptrend line that I've drawn in, and
Yes.
lo and behold, our current condition is dropping. We're down below zero now on this indicator for the last 4 or 5 days.
Mhm.
And we've taken out that we have lower lows all the way across here as
Mhm.
this advance was running out of steam, and we now have a lower volume summation high at the peak in this year compared to the peak, and that did not make a higher high on the New York Composite.
Mhm.
And now we've broken this uptrend line and we're into negative territory. And how far down is maybe somewhere around where these are. We'll find out.
So would you call this picture very worrisome, slightly worrisome?
What it says is that this top is a very important top.
Mm-hmm.
And this, all these dots are showing that the oscillators being very negative, and that's going to take some time. This is a major consolidation at the very least, and if we get below the 1% trend on a daily AD line, we're into bear market conditions.
Mm-hmm.
So that's what how far down is, we don't know.
Okay.
But it's in the process of being down.
Wonderful.
What is the title on this chart?
This is the Dow Jones
Business.
close and price oscillator.
All right. Now this is the last chart that I'm going to show you, but it's a very important one. That if we use the closing price for the Dow to drive a 10% trend and a 5% trend, and take the difference between them, which is a McClellan oscillator for the price, then we get this price oscillator. And a price oscillator looks very much like a summation index. And if we use the daily change in price instead of the price itself, then we would wind up with a picture of what a McClellan oscillator would look like. So this really is a summation index equivalent, but we call it a price oscillator because it moves like an oscillator, and it's driven by the closing price on the Dow.
In terms of percentage change.
So we see again when this is going up, we have price increases, and when this is going up, we get price increases, and when we get this, we get price increases, and this is making higher ones and higher ones as this goes on up. So and this downtrend came across, and we checked that at the bottom in 2019. And lo and behold, we came down and hit that line again in 2022. So it was an important line. And then I've drawn another line across from the COVID low across that 22 bottom. And that goes on up. And the price high on the Dow was in the fourth quarter last year. And that was made with a price oscillator at this level. And we did not make a higher high this year on the Dow Industrials, only on the S&P. And we had a top on the price oscillator that came up and hit that line precisely after the drop to the January low on the price oscillator and the price. And then we came back up and hit that line. So this is an indicator that has relations to the COVID bottom and the bear market bottom in 22. And we came up and hit that line at the January, at the February high.
Right.
Which is also these two tops are associated with a 41.5 month cycle or 186 month cycle. They're around there.
Yeah,
And
186
so
weeks.
that's why we're interested in what is going on at a cycle peak. And if you drew a line across these highs, they'd be right on a line. So
Right.
but I find it very interesting that here's an indicator that can relate the COVID bottom and the bear market bottom in 22 and the high price at the beginning of 2025.
That is very interesting.
And now you can see there's wide separation of the dots.
Yep.
And then today's down, we're down 458. So this is going to continue another dot right in here. I don't know that we'll go down and hit this line, but we are down taking out these lows. So if something important is going on, and this decline needs to be taken very seriously.
And it's going to take a lot to recover from it.
This is what McClellan oscillator and summation kind of things can tell you.
Fantastic. Well, that was very helpful to me, especially the part to understand that this is really about acceleration, right?
Yeah.
And then most people aren't really
acceleration by how far the dots are apart.
Yeah.
And we're measuring momentum by how we're relating to the zero line or the neutral level, and whether it's staying mostly above or whether it's staying mostly below, and how it changes direction is important, and how much direction change you get is important.
I'm seeing Marion's influence here and Marion's hand and all the mathematics behind the scenes.
You can see why these indicators are extremely useful in conjunction with cycle analysis.
Yes.
Because we have cycle bottoms that are important, and we have cycle tops that are important, and we can use these indicators to determine, are they behaving properly? Are we having right translation or left translation according to the price structure in relationship to where the cycle tops are?
We could take a quick look at that on the cycle analysis tool on the Dow if you'd like to.
Fine. So
do you have any, was this the last chart that you had, or did you have another?
This is the last chart.
Okay, except I think you did have one more. If you could go to the last slide, just to show where people can follow your work and subscribe to get the analysis of, this is a family business, right? Tom McClellan,
It is a family business. Tom and I, Tom graduated from West Point and flew helicopters for the Army for a few years.
All right, so you can get some if you want to pay. You can get the articles, but I get the free articles, and I go over it to you guys here. I think that's enough information, from that stuff. So let's see. Yeah. So let me go through some history first. Let me go through some history. So here's a little history here. This 2004 MTA Lifetime Achievement Award, and this was a speech, I believe, or at least a booklet that came with the speech. And yeah, you can read this PDF. I have the link in the description. You can go through it. And he's talking about trends and all that. Where this is actually an exponential moving average. So let me read this for you. Harlan introduces exponential moving averages. This use of the advanced decline, statistics, caught the eye of a man named Peter N. Harlan, who worked as a rocket scientist for the Jet Propulsion Laboratory in Pasadena, JPL. I think you guys know that from Candace Owens, right? Candace Owens was talking about that stuff all the time. Anyway, let me put some music up here. Chill vibes only. So let's go down here. Harlan also had an interest in the stock market technical analysis and was among the first people to ever use a computer to help him do technical analysis. This is because in the 1960s, he was one of only a handful of people in the world with access to a computer. Harlan did his day job plotting trajectories of satellites and other work for JPL, and then at night he would tabulate stock prices and other data from the newspapers and encode that into IBM punch cards. This way he could enter and process data into JPL's computer, the only one west of the Mississippi River at the time, during the evening hours when it was not being used for work-related purposes. All right? So you can read most of this stuff on your own, and you can see how they derive the exponential moving average from the trend. So that's what he called trend. 10% trend is basically a 19-day exponential moving average. Okay. And if you want to know more about exponential moving average, you can look up windowing functions and things like that. And the other thing too is that, let's see, he goes through the history, I think. Some other history, maybe not. Maybe it's not here. But yeah, you can read the PDF if you want. But that's how the whole exponential moving average thing was derived. So unlike simple moving averages, which is like a box filter, simple moving average makes everything the same weight and then cuts it off after the past. So if you have a 10 simple moving average, you're only getting 10 data points, the present one and 9 past points, and then ignore the rest. Exponential is essentially you weight it down. So you take the front present data and you weight it more than the next ones all the way to the past. All right. So let's look at this. I think he goes over the history of McClellan. So you heard from Samuel, right? I think. So let's see. Tour de force from a veteran with pedigree. Tom McClellan, that's the son, on market breadth. Okay, one of the many excellent international speakers the SDA has invited to our webinar-based monthly meetings, now build Ask the Experts series. With Tom, we get to hear things straight from the horse's mouth. Editor of the Tom McClellan of the McClellan Market Report newsletter and his companion daily edition. He's a graduate of the U.S. Military Academy at West Point, served as an Army helicopter pilot for 11 years before taking up a new career as a stock market analyst. He is a son of Sherman and Marion McClellan, who together created the McClellan Oscillator Index in 1969. My mother was a computer and maths major, who then went on to also devise the McClellan Summation Index, and I benefited from not having a degree in economics. At the age of 6, his parents gave him one share in Walt Disney stock. Sadly, he sold this in the 1970s to buy a Yamaha motorbike. His attitude towards the market, he says, where his focus is very much on U.S. stock indices, is more akin to that of a physicist who is looking for the best canaries in the cage. Okay. So that's good, some history there. And, I want to revisit this article too about gold shows an oil price bottom ahead. So this was written in May of 2024. If you listen to that video I played with Larry Williams, he was using gold too to predict, or he was using oil to predict the gold prices. And McClellan here uses gold to predict oil prices. That's pretty interesting. Now I'm using, I use this one like the 19.8 months forward. Now the interesting thing too is it also predicts grain prices. I believe he writes it in some of this article. I think, let's see, grain. Oh, he didn't write in this one. Okay, let me try to find it. It's like he wrote so many of these articles which have the same thing. Let me see if this one is it. Oh, okay, it's this one. All right. Here. This is this one. They're pretty much similar articles, but here, this one, he gives you a nice thing in there. Gold is valuable not just because you can sell it for a lot of money, but also because it gives us answers that we cannot get anywhere else. Gold serves as a great leading indicator for lots of things, leading the changes in grain prices by about 15 months and foretelling the movements of oil prices by just under 20 months. Okay, so yes, please take that into account, because I think that's very useful for a lot of you guys to understand. And I'm gonna put up the chart for gold predicting oil, because I expect like June to be a nice time to be looking for a bottom in oil. Okay, and we gotta look at oil companies and natural gas companies very shortly in the coming months, I believe. So yeah, let me get that thing here. Okay, get that, remove this, put this one up. All right, so I've showed this chart before. You can see the oil prices here, and this is the gold price where I shifted 19.8 months. And yeah, we should be hitting a bottom around June right here. So we're in a little sideways patch to downward patch, and then from then on we should be good until December 2026. And if gold is actually going higher, we can go up a little bit further into 2027, early 2027. So this run up, I'm expecting. I did show some cycle charts for oil in the last stream, so go check out that last stream and see what I analyzed over there. So should be good going. Okay, let me get back to the article. Okay, so let me get that. Okay, so there, blah blah blah. So yeah, you can read this yourself. I'm gonna go to this one. Okay, the chart of gold. Let's see. This is assuredly not a perfect model, just a really good one. Occasionally, it gets out of whack. Most recently, when Russia invaded Ukraine and disrupted the oil market in the process. But after every episode of the correlation getting weird, prices work extra hard to get back on track again. Okay, so yeah, we'll see how this goes. I think so. I'll put both of these articles for you to read. The latest one here. Okay. Hey, what's up, Ignat? Yeah. Maybe when I get my when I get more precise, and I get the dang Substack going, Ignat, yeah, I'll do that. I'll make some newsletter, but for now it's free because, like, I'm not that accurate. I'm not gonna. If I get super accurate, when I, and I can get more like the consistency that I can give to people, yeah, I'll give it to you guys. For that, and we'll start going from there, and then we'll see what John thinks about it. So yeah, you could get this archived article. That's one of them, and then here's the other one. Okay, it's on the screen. So those are two links on the screen. And the other thing to talk about was the Max Payne. So Max Payne is 584 on the SPY. So yeah, the S&P is gonna try to go towards that level. So let's see what happens this coming week, and then go to 499 on the QQQ. So yeah, we can go towards that level, huh? We ended at 478. on the QQQ and 562 on the SPY. So I'm watching that. I'm watching to see how we go. See how we go there. See anything else to talk about? Oh, I saw this one, this tweet. Yeah, everybody's screaming about this thing here. So let me read it for you. This is TF Metals report. Must be a gold bug, you know, some guy who's really bullish on gold. But I thought this was interesting because he screenshotted like the Bitcoin Act that what was it? I think who commissioned this? Let me see. Bitcoin Act was Senate. Was it the Senate or somebody? So who's doing the Bitcoin Act here? Senate Banking Committee. Yes, it was the Senate Banking Committee. All right. So yeah, I was right. Senate Banking Committee. So let's see. Last week, both the U.S. House and Senate put forth something called the Bitcoin Act. The act proposes that the U.S. acquire 1 million Bitcoin, okay, over the next 5 years. How and with what fund? Buried in the bill is the wording that you see below. Is this why gold has been rushing into the U.S.? So let's read this. Federal Reserve System gold certificates. Not later than 180 days after the date of enactment of this act, the Federal Reserve Bank shall tender all outstanding gold certificates in their custody to the Secretary. Not later than 90 days after the tender of the last such certificate, the Secretary shall issue new gold certificates to the Federal Reserve banks that reflect the fair market value price of the gold held against such certificates by the Treasury, as of the date specified by the Secretary on each new gold certificate. Upon issue by the Secretary, each Federal Reserve bank that receives a new gold certificate shall remit the difference in cash value between the old and new gold certificates to the Secretary for deposit in the general fund within 90 days. Oh man, well, so all those gold certificates that's still out there, they're priced in what? Who knows how long? They got to be repriced to the current fair market value. All right. Conforming amendment, section 5117B of Title 31 United States Code is amending by striking for the purpose of issuing those certificates of 42 2/9 a fine troy ounce. Wait, hold up here. So it's about $42 a troy ounce. Was that the original price? Hey, that's ridiculous. We got inflation here, guys. Oh, so that's interesting. Is that why they got the Fort Knox? I don't know. I think John needs to look into this. Here's another thing that was posted here. So here's a great theory on Trump's plan originally proposed by Lead Lag Report. Okay, if you don't know Lead Lag Report, it's by Michael Gayed. So I'll put here. You can go Google him. Lead Lag Report. And I think he has a YouTube and podcast and all that. I don't listen to him too much. I think the guy's kind of like these macro guys really go too far out with their theories, you know. So Lead Ag Report, I think his name was Michael Gayed. So it's Gayed, all right? So here. So you can look him up, verify if this was actually written by him. Trump is trying to crash the stock market at least 20%, causing a flight into treasuries. This will cause the Fed to slash interest rates so he can refinance the debt to near 0% and cause a deflationary spiral, which will lower the cost of everything. He also intends to use tariffs as an incentive for companies to build in the United States to avoid having to pay them. The tariffs and the resulting global trade war will also force American farmers to sell more of their goods in the U.S. due to retaliatory trade measures by other countries like China, which will directly lower the price of groceries in the United States. Oh, wow. Okay. More than 94% of all stocks is owned by just 8% of the U.S. population. Trump is literally taking money from the rich and giving it to the poor. Wow. All right. This is why Trump is playing a game of hokey pokey with tariffs. One day he has 25% tariffs on Mexico, and the next he doesn't. This is to cause extreme volatility in the markets and a desperate need and demand to flee towards treasury bonds, which are much more stable but offer much lower potential return. This is also why eggs are cheaper now than they were. All right, so okay. That's great. Fine. If you're gonna believe this wild theory, this is great. So I'll put this one up here. All right, and you guys can read that if you want. Don't kill the messenger. Don't kill the messenger. So like White Jaw Galt wants to say, oh, you read too much. Well, Stanley says I don't read enough. I think if Stanley was here, why do you blame this on Powell? Because the charts, my friend, the chart says so. That's why. Because this whole range was set off in December, so that's why we're here. And then we broke the range down. All right, got a link. No 12th man, I'm gonna end this soon. There's gonna be no thing here unless you're gonna have to wait for Stanley if he comes up later tonight. Yes, I know that, White John Galt, you keep saying that all the time, but this is how I make my money. I don't care. You do what you do, I do what I do. That's the end of it. You can slice your eggs one way, do whatever you want. Those eggs are getting very expensive. Slice them, dice them, however you want. Make them fried, make them sunny side up, make them scrambled. I don't give a fuck. All right, so that's about it here. I think you can read that. Let's see, anything else? No, I don't think so. I'm done. Yeah, you can say whatever you want, but you keep removing your comments, so none of us can see what your predictions are. Are you trying to purposely hide your comments now so no one can screenshot them and call you out? All right, anyway, see ya guys. It's 2 hours, right? All right, it's 2 hours. I gotta go, guys. Gotta go eat. It's 8 p.m. my time. Gotta go eat. Let me see if I got anything else. No, I don't think so. I'll see you around Sunday night if anything interesting happens. Okay, yeah. But otherwise, nah. Just keep doing what you guys are doing. So if you bought the dip on Monday, you should have got a ton of money already, from that. So Tesla, Nvidia, those dips from there, SMCI, and then you have MSTR. MSTR was great, yeah. So I think that was great. That was a great one. Shit, man, should have got more of that one. Oh well. Oh, SMCI was pretty good too, actually. So I can't complain. Or whatever. So that was a good week for that, but otherwise, yeah, we'll have to see what's gonna happen. Let me see. I guess I should show you the calendar. Let's see so we got the Bank of Japan on Tuesday. Yes. Okay, Sunday we'll have some Chinese numbers, so maybe that'll do something in the Asian markets. And then we have retail on Monday, and that'll be 8:30 a.m. Eastern for retail numbers. And then housing starts, building permits 8:30 on Tuesday. Maybe that might matter. Then we have Bank of Japan, so 8 p.m. my time, so that'll be 11 p.m. Okay, Tuesday, very late night. All right. Let's see what else. Yeah, and then Jerome Powell talk on Wednesday. All right, 11 a.m. my time, 2 a.m. Eastern. All right, I mean 2 p.m. Eastern. My bad, 2 p.m. Okay, Eastern. Let's see. Yeah, nothing else to say. Nope. I think we're good. We're good. So remember those things, and I'll see you. Oh, and remember to donate. Please donate. Let me put back up the banner here. Yeah, I should donate to Portia. She's working hard, you guys. And let me get all the comments up. Okay. Let's see, we got 1.29k subs. Please like and subscribe. You got support the Streamlabs, streamlabs.com/TheUrbanLandord. And you can do Porsche's Cash App here, $PORSHAJAYE, and PayPal at PORSHA@jghb.info. And you can email me at CRACK@jghb.info. All right, guys. Good night. Good night.
Feel like I should, feel like I should, feel like I should, feel like I should go. Go. Feel like